We saw a dramatic move in Apple in the month of February, down about 6%. Have you been building a bigger position in shares and taking advantage of the pullback?
Well, certainly after last year's run in Apple, it's hard to be adding a lot to existing positions. But certainly for new clients, we continue to add Apple. And we continue to be very bullish on it for the long term. We're particularly heartened when people like Warren Buffett recognize that technology stocks can be value stocks and that share repurchases are very powerful for the long run for a company like Apple.
Trading at 127 a share, it's below its all-time high. What would be fair value to you?
Well, fair value, we really look at it on an earnings and an EV to EBITDA basis. So, we're probably looking in the 150s to 160s for what current fair value is. It's one of the few companies that continues to show the ability to organically grow new business lines. The pandemic didn't really shut them down, so the store opening wasn't really as big a story to us as perhaps it was to the market. But you've had a bit of a revaluation of some of the higher valuations in tech stocks over the first 2 months of the year. And I think there was a bit of a relief rally after there was a lot of pressure on a number of them.
I'm just looking at a 6-month chart of Apple. It's basically traded in a narrow range. It's down about 2% over the past 6 months. What needs to happen for this? What would be the next catalyst for this stock, I guess?
Well, everybody knew we were going into an iPhone super cycle, and a lot of that got priced in throughout the summer. They were also able to successfully sell phones even when their stores were shut. So for Apple, it's really growing into the valuation that had gotten perhaps a little bit ahead of itself. And you're right, if you look back to August and September, we're really close to those same levels, which is nice in a stock, really. Stocks are not going to go up 40 and 50% a year. You do need periods of consolidation for the earnings to catch up to the valuation.
I think Apple is one of those, Apple is one of those stocks, as you say in your notes here, that not only offers growth, but it does have a dividend yield, and it continues to grow its it continues to repurchase shares as well. I'm wondering if yields do tick up again and we get to that 2% level that some analysts are calling for this year, if that could compete with Apple's yield.
Well, I don't think anybody owns Apple just for the dividend. It's just nice that you may have long periods of consolidation in a stock that you get paid while you wait. And I think really what it is Apple's incredibly strong cash position and capacity to both issue debt when rates are cheap and buy back stocks, is what Warren Buffett was referring to. And they continue to just be fantastic stewards of capital.
All right, Tim, while we have you, we're also watching shares of Zoom. I just want to put up a screen. Popping once again in pre-market. It was higher as much as 11%. Now seeing a gain of around, 8.6%. Zoom says sales rose nearly 370% year on year. Outlook also topping estimates. Tim, I think some of us kind of cringed when we looked at Zoom's earnings and thought, oh no, an upbeat outlook for the future. I guess we're going to be working from home for perhaps a foreseeable future and not returning to face-to-face. But what stood out to you in that report?
Well, what stood out to me, certainly it's eye-popping kind of growth. And the hard part is Zoom really didn't need to have such a bullish outlook, right? They said a lot about their future earnings expectations when everybody's expecting, as we reopen, that this has been more persistent than we expected. But we are going to see people going back to work. We are seeing people want to go back to work because they cannot work at home, but they have children at home. So I'm a little bit skeptical of the future growth rate that they laid out, even though their service is fantastic and we're all learning a new way to do business. I just don't see those kind of growth rates in the future. Yeah,
we did see a deceleration in some metrics, including sequential sales growth, customer acquisition, RPO, led by the Americas region. But what's the biggest risk in holding shares of Zoom here as the economy reopens?
It's straight up valuation, right? Here you have, as the economy opens, you begin to see other companies become more attractive, whether it's the energy sector or the financial sector. So people will eventually roll out of the highest valuations and roll into more reasonable and attractive valuations. So it's not Zoom's business that's at risk. It's just the valuation of the stock.
In competition, Microsoft and Cisco, which name do you think is giving it a run for its money, if at all?
I think Microsoft is really giving the most run for the money. It's interesting that Cisco's been in this business for a very, very long time, but really unable to capture the consumer side of that business, which Zoom has. And as people learn to use things like Zoom and Teams, there's only going to be 2 or 3 players that maintain that persistence. There are 6 or 7 players out there. I know that I have WebEx meetings, I have Zoom meetings, I have Skype meetings, and I have Teams meetings. So it's really about how people do business. And I think that's going to be Microsoft Teams on the business side and Zoom on the personal side.
Shepard Smith here. Thanks for watching CNBC on YouTube.